Yeah. Right. They are.
Oh no, did I turn it off? I hope it's still active. Um,
Okay. Yeah, I don't think they look at it like that.
okay, awesome. We are live on StreamYard. I have no idea how to use this tool. Just make sure I'm appearing live on Instagram. I want to make sure of that. Which I don't think I am, so let's try to figure this out real quick.
We were together at Brian when Danny opened it.
Find it at the top of my feed on Instagram. Apparently it says I am live.
To be honest, I haven't checked my regular email because I've just been trying to get some work done. Do you want me to check? Or?
All right. See, it says YouTube. It says. Okay, now let's do this. Let's open this up. And we'll do another live video. Public. Copy that stream key. Let's see. Okay, I think we are live on Instagram now. Hopefully. Connect streaming software. Working on getting this figured out. Never used StreamYard before. Okay, here we go. It says go live on Instagram. Cool. Okay. All right. Now that we got that out of the way, welcome one, welcome all, welcome to my DSCR class. Today we're going to be talking a little bit more about DSCR loans as per usual. Got a couple projects that I'm currently working on. Well, one currently is actually local here in PA, Pennsylvania, Pennsylvania. It's going to be a Morby method. So super excited to be able to take part in this, help those investors get this done. So yeah, I'm looking forward to it. Right now, the biggest hiccup is it being a rural property. I wouldn't even say biggest hiccup. I would say this is a slight hiccup. And so what we're looking at doing is a pre-screen just to see if the property is going to qualify in this rural area. The lender sees it as rural because it is less than 10,000 people. And so, yeah, if you have a rural property, it is definitely a little bit harder to find a lender for you. So that's definitely something you want to look at when you're going into this. It has been a long and eventful day. Aside from that deal out in PA, I've been doing a lot of networking, trying to find some problems to solve. I wouldn't say DSCR in particular, but there's a couple lending deals that might be opening up. So I'm looking on finding some connections for those.
Yeah, but bigger jobs and bigger money comes with bigger bills and bigger responsibilities.
All right, well, cool. Let's get started. Let's talk about some DSCR. Uh, oh, okay. Just learned that I cannot see Instagram comments from StreamYard. So, Javier, is this loan just like a regular loan product for a house? PITI, does it also have PITI? Hopefully I don't sound stupid. No question is stupid. Great question. So this loan is, I'm not going to say, it is very similar to a regular loan. A DSCR, debt service coverage ratio, it's a business loan. Okay, and so the difference being it still has PITI involved. That's going to be one of your qualifying factors, PITI plus any HOA fees. That's going to be part of your DSCR calculation. So in that regard, it is the same, but I would say the main difference is this is, it's meant for investment properties. It's meant for people with variable income. And so you can't do some of the things that you could do with a residential loan that you could do with this, like a house hack. But diving into that ratio a little bit, to calculate that, you're going to be looking at, your PITI, like I mentioned, principal, interest, taxes, insurance, any HOA fees that might be associated. And then, so you're going to look at your debt payments, and then you're going to look at your cash flow. And so when you're calculating this ratio, you take your cash flow and you divide that by your debt payments. And so just to make it simple, if you have $1,000 in cash flow and you've got $1,000 in debt payments, you have a 1-to-1 ratio. And so what lenders are typically looking to see is that the property has enough income to cover its debts. And so having a 1 ratio is going to mean that you're breaking even. And if you have above a 1, that means you have cash flow. So a 1.1, 1.2 or higher is typically what a lender is looking to see. It means the loan is less risky. But you can also have a negative cash flow situation and still get a DSCR. So that's going to be anything below 1. So, 0.9, 0.85, whatever it is below 1. And then there's also a thing called a no ratio DSCR loan. But obviously, when you're looking at those two products, you're probably going to have a higher interest rate. And so that you want to be a little more careful in your planning of what your exit strategy is going to be on those. So you definitely want to have that in mind beforehand. Hopefully that answers your question. I know it was kind of a long-winded answer. All right. So with that out of the way, let's break down some basics of DSCR loans. So like I mentioned, they are business purpose loans based on the property's cash flow, not your personal income. So there's no W-2s, there's no tax returns. The lender is not digging into any of your financials. Actually, they're going to be looking at your, they're not going to be looking at your financials. They're going to be looking at your credit score. The credit score does matter with a DSCR loan. That's one common misconception. The lender will look at your credit score. They're not digging into your financials, so they do need a way to determine if you're a good borrower or not. Okay, so credit score, cash flow, 1.1 or higher, 1 or better. 1 means you're breaking even. And then you're going to want to be able to source a down payment. So typically most programs are, 20% down, 80% LTV. One of my lenders actually just upgraded their program and they're doing 85-15. So that's definitely something to look into. But a lot of these loan programs are definitely the same. But you can, when it comes to getting that down payment, you can use what is called gift funds. And so that's really cool because if you don't have the cash to bring in, you can go and find somebody. Now, this is just for an example. There are some stipulations when it comes to using gift funds. But just for example, just to keep it simple, if you're using gift funds, say, you don't have the money for this house you want to buy, and your mom or other family member is like, hey, I'll give you that cash. You don't need to pay me back. I'm not expecting it back. This is a gift. And so that is what a gift fund is. And so that's going to let you get into some of these deals with a little more money in out of pocket, with a little less money out of pocket, excuse me. So yeah, that's a good way. That's a good way to get into some of these deals is using gift funds. Let's see, the formula for calculating that. You're going to use your property income, divide that by the debt payments. Okay, so if you have $2,000 in income and you have $1,000 in debt payments, you're looking at a DSCR ratio of 2. I need to get a whiteboard because this would be way easier to just draw out. So you take that 2,000, you divide it by the 1,000, and that's your debt payments, and that's going to give you that ratio of 2. And like I said, lenders are looking to see a 1.1 or higher. That just shows that the property is cash flowing. Another good thing about these loans is there is actually, okay, cool. I'm glad you understand. I had to pop back over to Instagram. I'll have to remember to leave this up because the comments are not popping up in StreamYard. And if they are, I have no idea how to look at them. So we're kind of figuring this out as we go. Definitely want to get out here and start educating people more about DSCR loans, because I think they're a great investment option, and I don't think they're talked about a lot, especially because there's a ton of tools that you can use. It's definitely going to be a lot better than some of the conventional financing that a lot of people are looking at. But there's, I mean, in terms of creative financing, you've got subject to seller finance. There's all types of these transactions. So just having another tool that you can put in your toolkit to help get some deals done, that's what I'm trying to do. All right. So talking about conventional loans a little bit, when it comes to conventional financing, like your FHA, your VA, you can only have about 10 of those loans in your name before lenders see you as too risky to lend on. Roger, I'm looking at a triplex 900K, each unit renting out for 2,200. That's 6,600 total per month. Okay. What is your question? I mean, that seems like a pretty good deal. Okay, you're purchasing. Gotcha. Okay. You can definitely purchase. Each unit's already rented out. 6,600. Where are you located? And a couple things that you should keep in mind when you're looking at a DSCR loan. So let's go over these real quick because that can definitely mess you up. Iowa. Okay, cool. So I just asked that because Des Moines. Some lenders have restrictions on the states they work in, so the more states that the lender is licensed in. So at my brokerage, we have over 30 different lenders. And so each one of these lenders has different guidelines. Some of the products are very, very similar, and the only thing that's going to change is some of the... Oh, no problem, Roger. The only thing that's going to change is some of the little nuances, per se. Some have no seasoning requirements. Some have a lower reserve requirement, things of that nature. So some things you want to look out for. How much reserves do you have? Okay, lenders are typically looking to see 6 months is going to be like pretty healthy. If you have 3 months, that is okay. Some lenders do accept that. And then there's, of course, lenders who don't have any reserve requirements. But as you get lower, that tends to look a little riskier for the lender. So that's just something to keep in mind. So that's reserve requirements. Now, real quick, to calculate your reserves, super simple, super easy. That's your mortgage payments, your PITI, principal, interest, taxes, insurance, and any associated HOA fees. Reserves as in funds set aside. Yep, you got it. And then you'll take your PITI, so your monthly mortgage payment, and you'll multiply it by however many months of reserves you need. So if your mortgage payments is $500 and you need 3 months of reserves, you need $1,500. Okay, so that's reserves. Now, getting into seasoning periods. Now, Roger, I know you probably won't be looking at this because you're doing a purchase. But when it comes to seasoning, that just means how long it's been since you have purchased or refinanced the property. And so when you're looking at seasoning times, now you have to keep in mind that DSCR loans do not include any type of rehab funds. This is something that comes up a lot because you can use a DSCR with the BRRRR method. And so that's where you buy, rehab, rent, refinance, repeat. And so that seasoning time is going to play a role when you're looking to refi after you fixed up this property. And so that's definitely something you want to keep in mind. Again, it varies by lender. Some lenders have no seasoning. Some have 3 months. Some have 6 months. That's just something to keep an eye out for. I'm going to pull up some guidelines here. And where are we at? Okay, so most lenders are going to be doing 80% loan to value, 20% down payment. I have one lender who recently updated their guidelines, and they're doing 85-15. Okay, so you're looking at a 1 to 3 unit. Okay. Let's see, what's something else you should be looking out for? Are you a first-time investor? That's going to be a big one. You can still get a DSCR loan as a first-time investor. Now, depending on the lender you use, there might be some restrictions involved. That could be a LTV reduction. Okay, first time, cool. So I'll look at a couple of these just to see. So like this lender, first-time home buyers are eligible with a 5% LTV reduction, which is going to be based on the loan to value, FICO, and loan amount. Let's see. Those appraisals. This is another one with 5% reduction. This lender has first-time buyers are ineligible for investment 1-unit properties. And then you have 90% maximum CLTV. So there's just going to be different rules depending on the lender that you're working with. And so you definitely just want to keep those in mind. Like some have restrictions on first-timers using gift funds. LTV, loan to value, yes. And so talking about first-time investors, obviously these loans are not just for seasoned investors. Kind of talked about that a little bit. Credit score, you have a decent credit score, that really does help. They're not looking into your personal credit history, but they're looking at that credit score to make sure you're a good borrower. So credit score, I would say 620 or higher is probably where you want to be at. There is a lender that I work with that goes down to about a 575. But again, you could have higher rates on that. So if you need to get your score up, that's definitely something to look at before grabbing one of these loans. And then I already talked a little bit about the DSCR loans not covering any renovation cost. If you're going to be using hard money, or you'd need to use hard money in conjunction with the DSCR. You could also use gap funding. You know, the DSCR is covering that 80%, and you don't have enough to cover the rest. That's where gap funding can come in. Ideally, I have to come with 20% down. In my case, 180 down. How will the monthly rent 660 come into account compared to the payments? Compared to the payments need to be made to the DSCR loan. Okay. How will the monthly rent 6,600 come into? Okay, you will have to come up with a 20% down. So in your case, 180K down. The monthly rent 6,600 come into account compared to the payments.
Oh, okay. Yeah. Well, there's this.
Compared to the payments. So that's going to be something that we're going to have to dive a little bit deeper into if we're going to have to actually like run a what's called a scenario. And so typically when someone wants to work a scenario, I'll grab some upfront information about the property, and I will take it to our account executives with the different lenders, and now I'll use their pricing tools. And that is really where you're going to see those not ratios, but that's where you're going to see how much you could possibly be paying. And so it's kind of hard to tell you how exactly that money is going to factor in without knowing what your debt payments are going to be, unless you already have an idea. I mean, you could have, I don't know what insurance is like out there. Of course, the principal is going to be a little bit hard to judge, but you can use your taxes. You can see if there's any HOAs in that area. And so I guess you can get a general rough idea, but it's going to be a little bit harder to kind of give you specifics without running the actual scenario. All right. Let's pop over to Instagram. Saban, what's going on, brother? No HOAs, units don't need any improvements. Very nice. So you got a turnkey property here. Okay. I mean, I'll tell you what, I'd love to hop on a call and see if we can get this figured out. Let me take a quick look-sees at my schedule. Yeah, I have some time tomorrow and over the weekend. Tell you what, I will drop. Does my Calendly? Yeah, I'll drop my Calendly link in the chat, and if you want to book a call, happy to run over this scenario with you. Make sure this is right before I put it in the chat. Even though I've typed this 200 times already. But never know. Yeah, so you can connect with me there. Also, if you go over to my, oh, actually, I don't have my link on my link tree, do I? I'll have to fix that. That way I can see, we're learning. This is great. Add Entry. Fantastic. All right. No problem, Roger. Man, I can't talk today. No problem. Glad to be of help, Roger. All right. Cool, cool, cool. So, some other things that we can look out for when it comes to DSCR is some ways to increase those ratios. And so that's going to be things like reducing operational expenses or increasing rents. Now, maybe some things you could do for operational expenses is something like installing solar panels. I've never installed solar panels. I know nothing about solar, but I heard it's supposed to reduce your electric bill over time if you do it right. Consult with someone who actually does solar because I don't know. But that's just an example. Increase rents though. You can fix up your property, do some renovations around the grounds. Just make it look a little nicer. You'll attract a higher paying tenant. If your property is not looking, super run down. Oh, thank you. But yeah, that's an idea for increasing your rent. Check local comps in your area so you can stay competitive with your pricing. If you see a couple of these are renting for X amount, maybe you can go a little bit higher. And then if you're not getting any bites per se, maybe you should go a bit lower. But you want to find that sweet spot to get some higher paying renters in there. So let's talk a little bit about the documentation that's going to be required. So, Roger, as you're possibly about to find out, you can purchase with a DSCR, but you can also purchase a property that is not currently being rented out. And so, in that case, what they're going to do is look at a 1007 market rent analysis. And so that is for multifamily properties. If you were looking at a single family, it would be a 1004. Pretty much the same thing. One is just literally for multifamily. But that's going to look at rents in the area and help the lender determine what your property would be able to rent for. And so another thing I like to mention is if you plan on doing short-term rentals, make sure you underwrite it as a long-term rental first. And that's because since short-term rentals are a little bit riskier, they tend to have a 5% LTV reduction on their products. And so that means you could be bringing another 5% to closing. Now, if you underwrite it as a long-term rental and afterwards you decide to turn it into a short-term rental, that's your freaking business. Okay? Do what you please, but now you don't have that restriction, that LTV restriction, and you possibly save some money up front. So that's definitely something to look out for. Short-term rental comps, a little bit harder to find. And then lenders will typically go off AirDNA. So there's a button on there that you can push, and that will tell you the occupancy rates, and what it'll rent for. And so a lender is typically looking to see 60 to 70% occupancy rates. And then, of course, when you're talking about, gosh, I just lost my train of thought. Lenders looking to see 60 to 70% occupancy rate. And then they're looking at what the property can potentially rent for in AirDNA to determine what your property could potentially rent for. The thing about short-term rentals, though, is that they don't always use. So if your property was being currently rented out, they might not look at your past 12 months of rental history. Okay, so they might not consider that. Some lenders will, some lenders won't. Some lenders use both. And so there's a little trickiness when it comes to short-term rentals. So that's just something to be cautious of. Okay, all right. I feel like I'm going strong, kind of. All right. So a lot of lenders out there. My brokerage is out in PA. We work with over 30 different lenders. In PA, I can do a lot more loans, but I want to focus on DSCR and getting people started in investing, getting uh, seasoned investors more properties, and so focusing on investment lending. There's a lot of lenders out there, and I'm honestly going to tell you that a lot of the lenders' programs are the freaking same in terms of that 80% LTV and that 20% down payment. Nuances, seasoning times, things of that nature. That's where they separate. And then of course some lenders, they just close faster than others because they have a streamlined process. Let's go, Roger. Seasoned investor. That's the goal. That's the goal. I'm actually so I actually got into the mortgage broker industry this year. Um, and so a little bit about me, real quick. I started studying real estate about a year or so ago, and I started getting into wholesaling because I was like, this seems like a good thing to do. It seems like everybody's getting in this way, so like this is how I get my foot in the door. Let's go. Uh, didn't work out the way I intended. Being in a rural area, things got expensive real quick, especially with gas prices. But I did it for about 6 months consistently, probably 8 months in total. That really wasn't working out for me, so I decided to switch to the lending aspect. Um, and when I became a mortgage broker, I really had to decide that, like, I needed to focus on a lane. And so I still have a W 2. I'm working to get out of my W 2. And then I plan on doing some house hacking. So I'm super excited to join you on that investment journey in 2025 because that is my goal. But you can't house hack with a DSCR loan. You can refinance with one, though. Okay. Getting back into the talking about lenders a bit, though. Um, Definitely, if you are working with a loan officer or mortgage broker, um, the difference being a loan officer will offer you terms from ABC Bank. A mortgage broker can offer you terms from ABC Bank, CDE Bank, FGH Bank. A lot of different options from them. One option from this one over here. Um, either way, whichever one you're working with, you want to make sure that you're telling them any information you might think is prevalent up front. Um, I know for me, I already have like a sheet that I use that like someone can fill out, gives me all the most of the details that I'm going to need. Um, but that's going to help so that, if I have multiple lenders and you're looking for, let's just say you need a low seasoning time, right? Well, if I don't know that and I don't know what you're working on, I could send you to the wrong lender who has a longer seasoning time, which you won't be able to use. And so now we're gumming up the works. We're slowing things down. So being upfront, making sure you tell everybody or tell your loan officer whatever they need to know about your deal is going to help things get processed a lot faster. Um, so yeah, that is I feel like that's a pretty crucial tip. Some challenges. Higher interest rates over conventional loans. These are riskier loan programs since they're meant for investment properties. So if you have a pretty good credit score, you're typically you might be about half a point higher than a conventional loan. Of course, the lower your credit score goes, and then it's based off the property's cash flow. So there are a couple things that can actually affect your rate. Reserve requirements, we talked about that a little bit. That's your PITI times however many months of reserves you might need. And then prepayment penalties, another thing to look out for. So when it comes to prepayment penalties, Typically, you can have from 1 to 5 years. And so that prepayment penalty is so if you refinance early, the lender still makes the money they would have made had you just, kept paying for that full loan term. And so, actually, kind of wrap an example into this from today. I'm actually working on a deal here in PA. It's going to be a Morby method. Quick overview is that it's going to be a DSCR loan and then a seller's second. So that's a tricky one because a lot of lenders don't allow a seller second. But I have a lender who does. So super excited to see how this one turns out. But with the prepayment penalty, like they have a 5-year prepayment penalty. However, they have an option for you can request to have a 1 year, but you have to pay a little extra. So that's some of the trade-offs you can have. You can opt for a lower prepayment penalty and pay for it. It's not, you don't have to pay for it with every single lender because they're all different. Some lenders, you could just go, I don't want a 5-year, let me get a 3-year, and like that's okay. But one thing to look out for is that depending on your prepayment penalty that you choose, your interest rate could fluctuate. So typically opting for a longer prepayment penalty is going to get you a lower interest rate. So that's definitely something to look out for. Think about how long you intend to keep these properties and what your overall end goal is. All right. And then, of course, harp on it again because your credit score absolutely matters. All right. So you can use these loans are pretty versatile. You can use them for single family, multifamily, commercial, mixed use being residential and commercial. So tons of different scenarios you can run these on. When it comes to mixed use, if you have, more on the residential side, a DSCR is going to be a great fit. But if you have more on that commercial side, you might want to look into a commercial loan because that just might suit your needs a little bit better just because of how the property's cash flow is coming in. Blanket loans you can use with DSCRs. And so a blanket loan is essentially a loan that will cover multiple properties. And so if you're using a blanket loan, you could have multiple loans out with different lenders, right? And then what you want to do is get this blanket so you can consolidate those under one net per se. So what this is going to do is it's going to probably simplify things a little bit for you on the financing end, keeping things straight for the end of the year, tax season coming up and all. But what it also does is it gives you more leverage, more borrowing power, because now you've got all these assets in the pool that you can borrow against. The big thing to watch out there is all these assets are now under one loan. Okay, so that means if you default, you could put your properties at risk. And so that's definitely something you're going to want to be wary of. Now you can use these on short-term rentals. You can use them on long-term rentals, mid-term rentals. Short-term rentals, they're going to use that AirDNA to look at that projected income. And then they're also going to be looking at that occupancy rate. 60 to 70% is what they're looking to see. If you have short-term rental comps, if you're looking at short-term rental, you got your comps, bring them to the appraiser, because sometimes it can be hard for them to find comps in the area. And so you're not allowed to influence the decision of an appraiser, but there is nothing against giving them additional documentation to help them figure out what the comps in the area are. So you're not influencing them if you're giving them accurate data. And then with appraisals, the other cool thing is when it comes to DSCR, you can actually order an appraisal up front and then transfer it between different lenders. Now you'll have to check with the lender to make sure they allow appraisal transfers, but this could save you some time and money, because if you're paying like, $400 or $500 for an appraisal transfer and it's taken, from a week to a month or something crazy like that, it'll definitely save you some time and hassle is to not go back through that. So making sure that, or getting that appraisal up front, making sure that you're able to transfer around between different lenders, that's going to be the big ticket. House hacking and refinancing. So when it comes to house hacking is a strategy where you can do this with a single family, but I'm going to use multifamily as an example. You rent out one unit and you live in the others. Of course, single family, you maybe rent out your basement, your attic, something like that, and do it that way. But if you do it correctly, then you're going to have reduced mortgage payments, or you might not, have a mortgage payment at all. You could actually be cash flowing, which would be really cool if you're getting paid to live in your own house. Now, typically, a VA loan or an FHA loan is going to be used for something like this. Can you use conventional? I'm sure you could. Haven't really dug into that too much, if I'm going to be honest. But with a VA loan or an FHA loan, you can, live in one unit, rent out the other units. However, if you go to refinance, you might be locked into the property for another year if you stick with the same programs, because those loans require you to live in the property as your primary residence. Now, I don't think it's worth to push the boundaries of, hey, I have this house, like, a couple blocks down, I'll just stay there, because you could get in trouble for mortgage fraud. It's actually one of the most common types of fraud in the mortgage industry, and it's not something you really want to play around with. So just try to stay within the guidelines, stay within the boundaries. So when it comes to that refinance, you could look at a DSCR, and what that's going to allow you to do is it's going to get rid of that restriction that you have to live in the property for another year. But then you can also use your cash out proceeds to buy your next property. The good thing about the cash out is you can use your cash out qualifies for your reserves, can also qualify for your down payment on another property. So great things to keep in mind. And then we got the BRRRR method, buy, rehab, rent, refinance, repeat. So that's a good strategy. Of course, you're going to use hard money, fix up that property. Hopefully you got it at a discount, because you're going to build some value in, and then you're going to refinance, pull that equity out, move on to your next property, and continue the cycle. And that's pretty much like cut and dry for the BRRRR method. I mean, that takes care of that. That takes care of hard money as well. 1031 exchanges. Now, I am not a CPA or tax advisor. I've never done a 1031 exchange, but I do know that you need to buy another asset with the proceeds that you got from the previous sale, or else you will be taxed on that money after a certain amount of time. How much time? Go ask a CPA or a tax professional, not this guy. So in that regard, you can use your 1031 proceeds to buy more DSCR properties. And with 20% down, depending on the asset you sell, I wonder how many properties you could actually buy if you're in the right area. These loans are great for things like Section 8, co-living, assisted living. Most lenders are looking at those as long-term rentals. Pad splits, kind of becoming popular. A lot of people in the investing world know about them. A lot of these lenders absolutely do not. Okay, so a couple of them have started to look into it and started to come up with some guidelines that you can, that they can use to help you operate a pad split. But most of the time, it's not working. So I've got probably one lender that'll allow pad splits. Uh, but with the other models, the co-living, the assisted living, the Section 8s, those are looked at as long-term rentals, and especially with the Section 8s and the assisted living, some of that is government funding, and so that's like guaranteed cash in your pocket, or cash for the property, I should say. You still need to look at your expenses and keep those in mind before you start plugging away in your wallet. Um, Mixed use properties, we talked about that a little bit, making sure the residential side is where most of your cash flow is going to be coming from. If not, you might want to look at a commercial loan um, for that other side. Getting into appraisals, kind of covered that appraisals are obviously going to determine the value of the home. They can be transferred, so you definitely want to keep an eye out for that. Um, I think that's about it. I know this was, at least for me, it felt like a little out of order. But we're gonna get there. We're gonna straighten this out, iron this out, make it good. Turn this into a Q&A that we're doing daily. We're just gonna try to provide as much value as possible. And so I'll typically be running these. I'm not gonna say typically. I will be running these consistently every day at 7 p.m. except for Tuesdays. I will not do Tuesdays at 7 p.m. Those ones will probably run a little bit earlier, just because two of my mentors go live Tuesday nights at 7 p.m. Highly recommend going to check them out. They are Sam Singh and Marlon Johnson. They do the Think Big podcast. They drop a ton of freaking value. It's actually kind of ridiculous. Tons of episodes. They are over 100 episodes now. Reached a huge milestone for them. But yeah, that's my Tuesday night. So Tuesdays at 6, every other night, 7 p.m. And we will be back. And the whole point of this is to educate and get more people investing, get more investors knowing about these DSCR loans, get more tools in the toolkit. And of course, as my experience grows and I become more knowledgeable in the industry, then I'll start doing some other things, maybe setting up some more. Well, I'm already working on a webinar, but I mean setting up more like a community sort of space, something like that. So I've got some ideas. They're all floating around in here. We're gonna get it figured out one way or another, but this is the start. This is what imperfect action looks like. And we're taking it one day at a time. Love it. But this is getting better. I'm the first couple times I was doing this, I was just on IG Live, and I went off my draft this time, but the first couple times it was pretty bad. It was pretty bad. Now I feel like I can just keep talking, but also want to make sure that I'm like staying in some sort of cohesive order, as not to confuse everybody. And so we're gonna work on being more cohesive. And I think it would be really cool if we could get some. Maybe I can get some of my lenders to come in. So when I say lenders, I mean the account executive that works with that lender. I was thinking I would like to have some of them I would like to get some of them to come in here, do some interviews. But I definitely gotta grow the audience. I don't have to grow the audience first. I guess I could just start doing it. We'll see. It's a lot of things to work out. It's a bit overwhelming. This whole social media thing's pretty new. Cool, cool. Love it, love it, love it. This was good. This was good. I thoroughly enjoyed it. Well, I will hang around for another couple minutes or so. If anybody has any questions, feel free to drop them in the comments. Roger, I think you might be the only one on YouTube. Thank you for attending. Thank you for your time. Thank you for your attention. See, I got somebody on Facebook. Thank you for your time and attention. I have no idea who you are because I can't see it. But yeah, we will be back tomorrow, 7 p.m. Work on some customizations, make this look a little bit better. There we go. Imperfect action. That's what we're taking today. Imperfect action. I could bring people into the studio. Yeah, we're gonna. Oh yeah. Yeah, we'll figure this out. We'll do some cool stuff. Oh gosh, what did I do? Cancel? Okay. That's why you can't put me in charge of technology. Let's go, Roger. I'm looking forward to seeing your investments next year. Let's go. Let's get it in the bag. I'll be right there with you. Gotta get in there myself. Make sure you're going to some local meetups in your area, getting connected, doing a lot of networking, because that's what it's really all about. I missed that out. I missed out on that my first year, and I'm certainly making up for it now in strides. It's a little overwhelming at times, but we're gonna make it happen. We're gonna make it work. Oh no. I hear my dog whining in the other room. He's gonna have to go outside soon. So, all right, ladies and germs, thank you all for attending. Follow me on Instagram. Got tons of stuff on there. Let me know if you have any questions, comments, concerns. You can find me on Facebook, TikTok, Instagram. You can find me on LinkedIn, but I can't log into my LinkedIn for odd reasons. We'll get into that now. But yeah, on all the socials, I'll eventually have this updated. So like you can scan a QR code or something like that up here, and you can find all that in one place. But until next time, see you guys tomorrow.